Imagine this. Two people each invest $1,000 on the same day. 5 years later, one person's investment is worth over $3,000, while the other barely made anything. They didn't work harder. They didn't get luckier. The difference came down to understanding one simple concept: stocks. Yet most people never learn what a stock actually is. They hear phrases like, "buy the dip," "the market is crashing," or "this stock doubled overnight," and assume investing is just expensive gambling. But here's the truth. Every stock represents something real, not a number on a screen, not a magic ticket to wealth, a real business. And once you understand that, the stock market starts making a whole lot more sense. So in the next few minutes, you'll learn what stocks are, why companies sell them, how investors make money, what causes prices to rise and fall, and the biggest mistake almost every beginner makes before buying their very first stock. Let's get started. What is a stock? Let's make this incredibly simple. Imagine your favorite coffee shop becomes so successful that the owner wants to open stores across the country. The only problem? Expansion costs money, a lot of money. New locations, new employees, new equipment, new marketing. Instead of borrowing millions from a bank, the owner decides to divide the company into millions of tiny ownership pieces. Each piece is called a share. When you buy one of those shares, you become a part owner of the business. Not the manager, not the CEO, but an actual owner. Maybe your ownership is incredibly small, but it's still ownership. That's what a stock is, a tiny slice of a real company. Why would a company sell ownership? At first, this sounds strange. Imagine spending years building your dream business. Why would you willingly give part of it to strangers? Because growing a business is expensive. The bigger a company becomes, the more opportunities it has. Maybe it wants to launch a new product, build more factories, expand internationally, or invest in better technology. All of that requires money. Instead of taking on massive debt, many companies choose to raise money by selling shares. Investors provide capital. The company gets the resources it needs to grow. And if that growth happens successfully, everyone benefits. The company expands, and shareholders own a piece of something that's now worth more than before. That's the basic idea behind the stock market. A simple example. Let's say someone starts a small electric bicycle company. Business is going well. Customers love the product. Demand keeps increasing, but the company can't build bikes fast enough. To solve the problem, the founder decides to sell part of the company to investors. Thousands of people believe the business has a bright future, so they invest. The company builds a bigger factory, production doubles, sales increase, profits grow. As the business becomes more valuable, investors are willing to pay more to own part of it. That pushes the stock price higher. Someone who invested early may now own shares worth far more than what they originally paid. That's one way investors make money. But here's the important part. Success is never guaranteed. If sales slow down, competition becomes stronger, or customers lose interest, the company's value can fall, and so can the stock price. That's why investing always involves risk. So who decides the stock price? This is one of the biggest misconceptions beginners have. Many people think companies decide how much their stock is worth. They don't. The market does. Every second, buyers and sellers are making decisions. If more people want to buy than sell, prices usually move higher. If more people want to sell than buy, prices usually move lower. It's all driven by supply and demand. But what makes people suddenly want to buy or sell? News, company earnings, new products, economic conditions, interest rates, even emotions. Sometimes excitement pushes prices much higher than expected. Other times, fear causes investors to sell perfectly good companies. That's why stock prices can move dramatically even when the business itself hasn't changed very much. Remember this, the stock price reflects what people are willing to pay today, not necessarily what the company is truly worth over the long term. That's an important difference. Where are stocks bought and sold? Imagine millions of people around the world trying to buy and sell shares at the same time. There has to be a place where all those transactions happen. That's where stock exchanges come in. Think of them as giant digital marketplaces. Instead of buying clothes or electronics, people buy and sell ownership in companies. Today, you don't need to stand on a noisy trading floor. With a smartphone and a brokerage account, investors can buy shares in just a few seconds. Technology has made investing more accessible than ever before. But just because it's easier, doesn't mean it's easier to make good decisions. Knowledge still matters. In fact, it matters more than ever. How do investors actually make money? There are two main ways. The first is simple. If you buy a stock for $100 and later sell it for $150, you've made a profit because the company's value increased and investors were willing to pay more for those shares. This is known as capital appreciation, and it's how many long-term investors build wealth. The second way is through something called dividends. Some companies choose to share part of their profits with shareholders. Instead of keeping every dollar they earn, they distribute a portion of those earnings to investors. Not every company pays dividends. Many fast-growing businesses prefer to reinvest their profits to expand even faster. Others reward shareholders with regular dividend payments. Neither approach is automatically better. It simply depends on the company's strategy. But this raises another important question. If all stocks represent ownership, why do some investors specifically look for common stock, while others prefer preferred stock? The answer might surprise you. But not every stock is the same. At first glance, every stock looks identical. You buy shares, you become an owner, and hopefully the company grows. But behind the scenes, there are actually different types of stock, and understanding the difference can make you a smarter investor. The two you'll hear about most often are common stock and preferred stock. Let's start with the one most people own, common stock. When someone says, "I bought shares of a company," they're almost always talking about common stock. Owning common stock means you're a part owner of the business. In many cases, that also gives you voting rights on certain company decisions, like electing members of the board of directors. Now, unless you own millions of shares, your vote probably won't change the company's future. But it represents something important. You're not just watching the business succeed, you're participating in it. Common shareholders may also receive dividends if the company chooses to distribute part of its profits. Notice the key word, may. Dividends aren't guaranteed. Some companies pay them consistently. Others skip them completely because they'd rather invest that money back into growing the business. The biggest advantage of common stock is its long-term growth potential. If the company continues expanding year after year, the value of your shares can increase significantly. The trade-off? It usually comes with more risk. Preferred stock. Preferred stock works a little differently. Think of it as a middle ground between stocks and bonds. Preferred shareholders usually don't have voting rights. Instead, they receive other benefits. The biggest one is priority when dividends are paid. If the company distributes profits, preferred shareholders are generally paid before common shareholders. And if the company ever faces bankruptcy, preferred shareholders stand ahead of common shareholders when any remaining assets are distributed. That doesn't make preferred stock risk-free. It simply changes the balance between risk and reward. Some investors value higher growth. Others value more predictable income. Neither choice is universally better. It depends on your goals. What happens when a company goes public? Not every company starts trading on the stock market. Most businesses begin as privately owned companies. Ownership is usually limited to the founders, early employees, and a small group of investors. But as some companies grow, they need far more money to continue expanding. That's when they may decide to go public. This process is called an initial public offering, or IPO. For the first time, everyday investors can buy shares in the company through the stock market. The company raises money to fuel future growth. Investors gain the opportunity to own part of a business they believe in. It's a major milestone, but it also means the company must become far more transparent by regularly reporting its financial performance. The biggest mistake beginners make. Here's where many new investors go wrong. They spend more time chasing trending stocks than understanding the businesses behind them. A company becomes popular online. Everyone starts talking about it. The price shoots higher, and beginners rush in because they don't want to miss out. That's called investing with emotion. And emotional decisions often lead to expensive mistakes. Successful investors usually ask different questions. How does this company make money? Does it have a competitive advantage? Can it still grow 5 or 10 years from now? Those questions are far more important than today's headlines. Never put all your eggs in one basket. Imagine putting every dollar you own into a single company. If that business struggles, your entire investment could suffer. That's why experienced investors talk so much about diversification. Diversification simply means spreading your money across multiple investments instead of relying on just one. No strategy can eliminate risk completely, but diversification helps reduce the impact of any single investment performing poorly. It's one of the simplest habits that can make a huge difference over time. Investing is about patience. One of the biggest myths about the stock market is that it's a place to get rich overnight. In reality, that's rarely how lasting wealth is built. Many of the world's most successful investors didn't succeed because they constantly bought and sold stocks. They succeeded because they found strong businesses and gave those investments time to grow. Markets will rise, markets will fall. That's completely normal. Short-term price movements are impossible to predict consistently. But over long periods, great businesses have often created tremendous value for their shareholders. Patience isn't exciting, but it's one of the most powerful advantages an investor can have. Final thoughts. Let's bring everything together. A stock is much more than a symbol on a screen. It's ownership in a real company. When that company grows, your investment can grow alongside it. When it struggles, your investment can lose value. That's why investing isn't about following hype, copying strangers online, or chasing the hottest trend. It's about understanding businesses, managing risk, thinking long-term, and making informed decisions. The stock market has helped countless people build wealth over time, but it rewards knowledge and patience far more often than luck. So before buying your first stock, take the time to understand what you're investing in, because the best investment you'll ever make is the one you make in your own financial education. If you enjoyed this video and found it helpful, don't forget to like, subscribe, and turn on notifications for more easy-to-understand videos about investing, money, and building long-term wealth. And if there's another financial topic you'd like explained, leave it in the comments below. Thanks for watching, and I'll see you in the next one.